Hello viewers, today in this video we will learn about the differences between IPO and direct listing. Direct listing refers to the way by which companies can raise funds from the public, or shift to a public company by offering the existing shares to the public. A few major features of direct listing are that the process needs little regulatory necessities. It eliminates the need for an underwriter. It is time-saving, and offers only a limited number of shares during listing compared to an IPO. Next, we shall see the benefits of the direct listing process. First is money-saving. Direct listing process is a money-saving process as the need for an underwriter is eliminated. Next, we have time-saving process. The direct listing process is comparatively faster than the IPO as it requires a few regulatory formalities. After that we have less or nil fee. Companies don't have to pay fees which they are liable to pay as in the case of a traditional IPO, since no additional capital is being raised through the direct listing. Compared to a 6 to 7% fee in traditional stock issuing, it is only 1 to 2% in DLP. Last, but not the least, we have nil lockup period. In traditional issuing, there is a certain lockup period wherein insiders and prominent shareholders are not allowed to withdraw or sell their investments. However, there is no such case in the DL method. Shareholders don't have to wait for a certain period to sell off their investments. Now, let's talk about the disadvantages of direct listing procedure. First, we will talk about volatility. Usually, the DL method is considered to be highly volatile because the price discovery process is eliminated. While as we see in the book building process, various investors select prices based on the worth of the company. Next, is no new capital. DL procedure does not lead to raising any additional money, which can be done through the issue of new shares. However, companies doing this have different goals. After this, we will talk about key differences between direct listing and IPO. First is goals. Each of the strategies is opted for with different objectives in mind. Startups or companies usually prefer IPO because they need additional capital. However, the DL process is different. Here companies do not wish to raise new capital. However, they wish to enjoy other benefits of going public, such as greater liquidity for current shareholders, more visibility, recognition, etc. Next, we will talk about cost. The direct listing method is relatively cheaper than the initial offering one. In traditional IPO, companies have to incur hefty costs to pay underwriters, advertisers, and investment banks. However, there is no such need for the DL strategy as stocks from existing shareholders are directly sold to the public. After that we will talk about research. For DL, companies must look for external help to support them in research and stuff. But since companies opting for IP offerings hire underwriters, they get additional marketing assistance, thus helping them boost stock sales. The last one is lock-in period. The direct listing does not have any lock-in period, meaning shareholders are free to sell their shares. However, in traditional stock launches, shareholders are not allowed to sell shares for a certain period as it prevents the market from becoming oversaturated. When the market becomes oversaturated, stock prices tend to fall. To conclude, we can say that direct listing and stock offering are the two ways private companies can turn into public enterprises. But both strategies are significantly different from each other in terms of objectives, costs, lock-in period, and more. But as an investor, you must focus on other crucial things, such as the prospectus, checking risk factors, and other documents. That's it for today, and I hope you found the video useful. You can contact us from the details mentioned on the screen via call, email, and WhatsApp. Thank you for watching the video to the end. Please do like, share and subscribe our video for the latest updates in the stock market.